we're going to dive into discussing the current market of housing as well as delinquency. Before I get there, I'm your host, Dave Putz from JKP Holdings. Alongside me, as always, Mr. Nathan Turner.
Hello, hello.
Hey, sorry about that for a few minutes, guys. What's up new, man? The summertime's coming to end, which is kind of sad. School's starting back up. And tell us about what you're seeing in the market currently and what's going on with the note space right now.
Really interesting. I'm seeing more and more seller finance notes coming up.
Mm-hmm.
It's been kind of surprising, honestly. I know it's been around forever. I mean, I did it back in the early 2010s, and it's been around so much longer than that. If you talk to some people that have been around for a little bit longer, it's been around forever. But it's just more and more lately, I feel like we're seeing a lot more seller finance, specifically people that are doing it as a business, where they're acquiring property, selling it on terms, and looking to sell the note. Seeing quite a bit of that lately.
Yeah, absolutely. I think this space is changing quite a bit, right?
Mhm.
Um, I think it, a few months ago, a few years ago, we dove into seller financing, and we've now
Mhm.
living and breathing it on a regular basis in the note space, something we didn't have 5, 6, 7 years ago,
Right.
right? It's amazing how we adjusted as times changed. For those who don't know us and are new to us, we've been in the note space for over a decade. And for the first 10 years of our business, we bought from banks, hedge funds, and we bought
Mhm.
non-performing notes
There
for
were
years.
thousands of them,
Yes.
thousands. And
Yes.
so we bought a pretty good share. I mean, not thousands, but we bought a pretty good share of those notes over the
Yeah.
time. And it's great. But that's one of the things I love about the note business. There are so many different ways to approach it. And so as times change, as the market changes, it's easy to sidestep and move into another version of notes that
Yeah.
it's always been there.
Yeah. Absolutely. Um, I think though, for our understanding, what do you think the major reason why it's changed?
That's a
What has
really good
changed?
question. I think a big part of that is rising interest rates. With interest rates being higher, it's tougher for people to qualify to bank. Um, I think
Yeah.
that's a big reason. I'm also hearing, and I'm curious what you've heard as well. I'm hearing from a lot of, especially in Texas, um, immigrants who are coming in who don't trust banks, and they're happy to pay a higher interest rate simply because they don't trust banks, and they would rather do a seller finance deal at a higher interest rate.
Yeah. It's it, it it's amazing because just a few years ago, reason we weren't buying seller finance, we didn't have to,
Hmm.
right? We were able to get a lot of that stuff done because of what was available to us,
Right.
right? And now we're in a spot where we're chasing 8, 10% returns just a few years ago. Now that's gone up because of our cost of capital has gone up.
Right.
Where we've done the last couple of years on the show is really connecting the owner finance, seller finance world, wrap world to the note world, because we can buy a lot more seller finance, owner finance notes than we can bank originated notes. And the major reason is interest rates changing, right?
Yeah.
Most people say, well, interest rates at banks are 7.5%, 8%. We're telling you, we're not buying the paper they originated 6 months ago.
Right.
We're not buying paper that originated a year ago. Most of the notes when we buy from those funds are coming from a couple years ago delinquency when
Yeah.
it trickles down to our level.
Yeah.
So
And,
when
and
we,
we're certainly
yeah,
not buying stuff from 4 years ago when interest rates were at 3%.
yeah,
It doesn't make sense for us or for them.
yes. And I think it's not available to us to buy the 7.5% loans, and we can't buy the 3.5% loans. And for
Mhm.
those who are creating notes, listen carefully. The reason is for me to get a 12% return, I need to discount your 4% loan dramatically down to get my 12. I have a yield
Right.
chart if you'd like to reach out. So that's the problem, right? And the fact that, listen, you can make a 30-year note, but a note value is in the property, the collateral, and the numbers behind it. So
Mhm.
when notes are sitting at 5%, to get a 12 is a lot of money change, right? So for me, it's really difficult to say. But seller finance notes, our 9.9, 10, 11, 12 always been there.
Yeah.
And now since I can't buy those bank originated notes, you guys in seller finance world are awesomely attractive.
Yeah.
However, we're talking off air. What are some of the issues you're seeing with the seller finance paper?
Uh, the seller finance, as much as I love it and I highly encourage it, I think that it's doing a great service to the world and the communities in general. It
Yes.
has to be done correctly. There is a right way and there is a wrong way to originate paper. So follow the rules, do it correctly, do it right. Not only then are you protected as the originator, as the lender, but then it's much more attractive to a note buyer like Dave or I, and then
Yeah.
we can pay you more. So it's for everybody's best interest, the borrower, yourself, and for us to do that correctly. Go through a mortgage loan originator, just do it right, and we can do so much more
Yeah.
business.
Absolutely. Um, so I know we have a bunch of stuff going on in the feed from LinkedIn and Facebook. We're streaming live on both services. This will be recorded. We'll be putting it onto our podcast as well as our the YouTube channel we have. But what we wanted to get into today is when COVID first hit, we are curious when the bubble was going to hit.
Mhm.
We're seeing a lot of seller finance people say, well, my value, my property is this dollar amount. And why are you guys not buying it? It's a 13 interest loan. Because the fact that we understand how the market goes and that can adjust in a blink of an eye. And that's scary for us, right? Because if it defaults, and we're a little bit hesitant because we live in a world where everything defaulted for 10 years, right? That we're expecting it to default. And if that happens, the only thing we have available to us is the house. And if that drops by 20, 25% because the bubble hit, we need to be able to sell it at auction. And that's
Mhm.
where we could become scary, right?
Yeah.
So
Ideally, we don't actually want to own the property. We really
never.
don't. And so it's if that becomes a situation where all of a sudden we become homeowners, that's our worst case scenario. That's not what we
Absolutely.
want. So
Absolutely.
we're looking to make this done correctly. We are going to buy at a discount because
Yep.
of that risk factor. And again, where we're coming from, everybody's going to default.
Yeah.
Everybody. So
Yeah.
that's kind of in the back of our minds.
Yeah. I'm waiting for myself to fall, put it that way,
Yeah,
right? That's our
exactly.
mindset. And I think for us, the only two things we really are very hesitant, and we've had shows about this. So if you're new, please feel free. Land and mobile homes just don't fit for us.
Hmm.
Um, I'm sure you get a lot of information from people. And if you are looking for land or mobile homes, we're getting those call outs from people who watch our show and saying, hey, just reach out and say, hey, listen, I do buy land, right? We just don't buy it. It just
Yeah.
doesn't work for us, doesn't work for our portfolios and
Right.
whatnot. Um, we are, for those who don't know, we are two different companies. We just work together on this show and collaborate on a lot of stuff. So there's things that Nathan will buy that I won't, and vice versa. But it's interesting.
Yeah.
So let's real quick before we bring our guest on. DME is
Yeah.
coming up in May of 2025.
Yeah. New date set May 2nd and 3rd, 2025, back
For
in
those who don't
Nashville.
know anything about
Can't
it,
wait.
what is it?
It is the place to get together with other note investors. So whether you're brand new or you're managing multi-million dollar fund, it's the place to come together, network, talk to other people, and hopefully get some deals done. That's really, really what we're hoping to have happen.
Yeah. And if you're a note creator, note originator, it is the place to meet your bride,
Oh,
right?
yes.
In the idea that, hey, listen,
Hmm.
I'm creating all these notes. I'd like to sell them, which is an awesome idea that if you've never heard of it, you can literally sell part of your note, some of your note, create a first second. We talk about this stuff on a regular basis because creating a first second allows us to buy that first at a discount where I'm coming out with an infinity return calculator that you guys can calculate and create a first and sell it Nathan or myself in a blink of an eye, get your debt completely paid off and have a second for the next 30 years paying you buck 25, $200 a month forever. And we're happy, you're happy, and get out of it. So if you're interested in that, please reach out and get back to me, and I'll be sharing that link. A shout out to a couple of our listeners for encouraging me to do that. So,
Yeah,
with
that's
that
exciting.
said, we've been waiting for a housing market change for a long time.
We thought it was going to be COVID, and it wasn't.
Yes.
Not in the
Yes,
direction we thought it would be.
correct. And interest rates went up. We thought it happened then. We thought everything was going on, right? And Melody, who was going to be bringing on a second, she showed up at DME. We didn't know who she was, what she's doing, and she impressed us the first second talking to her. So I think for me, bringing Melody on here is awesome. If you don't know who Melody is, please look her up. She's a huge YouTube following. It's just amazing to hear from Melody. So, Melody, welcome to the show and thank you for joining us.
Oh, thank you so much for inviting me. And you guys have been amazing in what you've taught me about this space. So happy to be here.
Awesome. Awesome.
And that's the first thing. First of all, you're impressed with our space. We're incredibly impressed with what you've done. So we'd love to hear about kind of your background. Where have you come from? What have you done?
Yeah. So, and sorry, I'm getting over a little cold. It looks like you are too, Nathan.
A little bit.
So I might have to cough a little, but, I fell into mortgage as most people do. So my background that started in this space was really in the mortgage space. And so I was in grad school looking at my student loans and wondering how the heck I was ever going to pay those. Being, 10 is not really something that people get anymore typically. And so I needed a job, and I had a lot of skills. I'd worked while I was in grad school at the Wall Street Journal. I'd worked for some private investment banking firms. And so I thought, okay, I'll be a project analyst. And so I saw a job for project analyst. I went, the guy said, "So what made you want to work at a mortgage company?" And I said, "This is a mortgage company?" I mean, I had no idea. Until this day, I've never had a mortgage, guys. Mortgage means death pledge. I have that same kind of, but we understand in this country, that's how we afford homes. And so I don't have anything against mortgages. I have, I encourage people to be prudent. But I ended up at that mortgage company in September of 2006, just in time to go to a party where they dropped balloons down from the sky and they had a life-size Lego house and this huge event. And I turned to my friend and I said, "Is this Enron?" Because I'd only ever seen people dancing on stage and this excited, from scenes from Enron. Sure enough, Cerberus, which was private equity, had just purchased us at the top. We were operating under GM at the time, General Motors, and we were hugely successful for them when they weren't doing so well. So we were the darling. And so private equity came in to purchase us. And then quickly, very quickly, I mean, in Q3 of 2006, we were at a 1.71 delinquency rate, but things just started snowballing from there. And because Cerberus wanted to adjust the purchase price, we were very early in taking our write downs, and because they had a gun to our head. So meanwhile, Chase, Citi, B of A, they were late to the party. And I would encourage everyone to understand they're always going to be late to the party. And I can I can give a quick example. JP Morgan just came out with its earnings release. When they were talking on the street, they didn't mention anything about their home equity portfolio being over 6% delinquent. Not a word. But if you go into their 10Q, it is. And so they're going to put off those write downs as long as possible. And so I would just say to everybody, if you're getting your news from mainstream media, you're going to be behind the curve. That's just the way it is. Unfortunately, it's just full of narrative. So anyway, so we led the charge in total chaos. We were number one on the list for most likely to go bankrupt from mortgage. What was that thing called? I can't remember, but it tracked that every day because mortgage companies were just imploding.
Yeah.
We did not for a very long time. We got saved by TARP. And so part of what I did for Cerberus was teach them the business, because we were this massive company. I had to go out all around the company getting management reports and tell them, okay, this is how this works. This is how that works. And so I got a crazy education in a very short amount of time that I don't think, I mean, it's a once in a lifetime opportunity to really get that kind of education that quickly. And plus, we were laying everybody off. So you're there, you're the only one left, right? You're keeping the lights on. And so from there, I kind of went and I helped manage our consent orders and AG settlement when we got into trouble in 2011. For basically what happened is we had too many defaults and the organization was kind of being starved. So we got TARP money, we got SAVE, we became a miraculous bank holding company overnight, even though we only had this tiny little regional bank in Utah, but it was, it was a
Mm.
lot of engineering to save us and GM. And then from there, we got into a little bit of trouble with the consent orders on robo signing affidavits for default. And all the big five did. And so we had to pay our regulatory dues. And from there, really, we knew that the operation would not make it. And so ultimately, we filed bankruptcy, and I helped to manage that. It was one of the largest, most complicated bankruptcies at the time, and it's still going on anyway.
Mm.
So from there, they said, okay, well, thank you for what you did with the consent orders, AG settlement. Thank you for helping us with the bankruptcy. Could you please go fix default? Because, all that trouble we got into, and now Fannie and Freddie are saying, hey guys, we understand we're not going to let you modify these loans. So you need to push these seriously delinquent loans, or we're pulling all your servicing, which would have tanked the auction and meant tens of thousands of people would have lost their jobs. And so I went out on the road all across the country with my document execution teams into attorney firms, because that's what you use local counsel to work with foreclosures. And I got a real education in default, and not one state, just all across the country. And there's not a lot of people that get that opportunity either. And so basically, with a lot of elbow grease, because we were in bankruptcy, Bank of America was paying these firms like, thousands of dollars to move theirs faster so they wouldn't get in trouble with the agencies. We just had elbow grease. And so I lost a lot of my life on the road those couple years. And then from there, after that was over, my Fannie Mae rep won an award because we did increase our pull-through rate. So she won the award. That's how that works. Yep. I went off to a whole bunch of non-bank originators and servicers, I thought what I was doing was actually helping them to kind of get up to speed with the new regulations. But what I ultimately have realized is that what all that was, all those regulations, Dodd-Frank, I mean, it was just lipstick on a pig. It was to make everybody think that everything had changed. Meanwhile, in the back end of the automated underwriting systems, they quietly removed in 2021 the DTI threshold, or debt to income threshold.
Wow.
So I think a lot of that was what I call it credit quality gospel singing. There was a lot of singing about how strict everything was. And I think if you talk to anybody at the end of the crisis, 2012 to maybe 2016, 17, things were very like lockdown, strict, crazy. But then, like loosely, as always, no one went to jail, or very few did. Things just started, opening back up again. And I was experiencing this and just thought it was my personal problem. I thought something was wrong with me, or it's the company I'm at. They don't want to comply. But no, it was industry wide. And in 2019, I went on a project. I was building technology. The last several years, what I was doing was building technology for the industry. And I went into an originator, and the front row of the car, the front of the building was just all Lamborghinis, Porsche. And I walk in, and I'm like, you have to be kidding me. This is happening again. Like, so anyway, all that we get to, the COVID boom, which was just pure insanity. I was working on an imaging project for PNC overnight after, COVID lockdowns are announced. We just get this flood of refinance applications. So we're processing images. We're processing over 1 million of them a day in 2020. I mean, it was absolutely insane. And it was, none of us slept, none of us ate. Like, from 2020 to, I would say, middle to end of 21, I don't think anybody in mortgage slept. And guys, that's a problem, right? That's when so many mistakes and things like that happen. And I really got out of there. I had this crazy little team that was doing loan processing, even though I was building technology. We were like this small fintech business process outsourcing company. And so you wore a lot of hats. But I could see some of the financials that were coming in. And if I got called in to look at an issue, you had crazy stuff like people all in Tesla. There's so much risk out there right now. I can't even explain. But then my president said, "Can you please just tell me when are rates going to rise? Because when is this party going to be over?" And that's all I could think about. When is this
Yep.
craziness?
Mhm.
And anytime I would talk to anybody about what was going on with home price appreciation, they would just dance. And I'm like, you do realize what happens with home price appreciation or HPA? Property taxes go up, home insurance goes up,
Yep.
costs of repairs go up. All of a sudden, you have a consumer that is getting stretched and stretched and stretched.
Yep.
But nobody wanted to hear it. They wanted the balloons to come down from the ceiling again. They wanted to create another Lego house. And so I started diving into macro. That's, David, when I got onto Twitter, even though I had no desire, I don't even go on Facebook. I'm like anti-social media, but that's when I really started connecting with other kind of financial media commentators, macro people, economy. And I really just did a deep dive into really a lot of things I studied back when I was in grad school, but I kind of picked it back up and studied it. And then I got on the road because people were saying housing's just fine. They were talking about no inventory. I was like, are you insane? Have you seen the permits? Like, have you heard them talking about all this multifamily? But nope, everybody said we're short inventory. So I got on the road. My first trip, I hit Nashville, Austin, Charlotte, several cities in Florida. And I said, guys, we don't have inventory issues. And believe me, at that time, everybody thought I was crazy. But
And
from
what
there,
time, when was this? What year?
that was in February of 23 that I
Okay.
did that first trip. I wrote an article for Housing Wire in January of 2023. It was called Debunking the Inventory Myth. And then because I got so much crap because people were like, data, data, data. And I'm a data geek. I love data. But they wanted, it's just so hard when the entire narrative is out there around shortage. And so I went on the road because I was like, I'm going to bring back footage. And I do that now with pictures or drones or things like that. People still didn't believe me. But I think I got us all the way to here now. So I'll stop.
Yeah.
I know that was a lot.
That's okay.
Oh, that's
So
fascinating.
I think your history and knowledge is something very unique, right? And you know that beginning because not a lot of people had the opportunities you did. I want to see from your point of view, because Nathan and I talked privately before meeting you about some woman who wants to learn about the secondary space. What was your understanding before you met the secondary space and then after?
I had no idea that even existed. Like, I remember when I first started, people would be like, secondary. I'm like, secondary to what? Like, what are you talking about? What is a secondary market? And I worked at the Wall Street Journal. I read financial press all the time, but it still was. And then, but what would that have to do with housing? And then I think it took me all these years I've been in it. It wasn't until very recently that I really codified in my own head how much government had gotten involved in origination and how, I knew they'd squeezed out private, but I don't think I've thought through those implications. I just knew it had happened, right? And I think often we think that if it's going into the government's hands, it's going to a safer space. No. That is not. We are now at a much less safe space than we were actually, in my opinion, in 2008.
And we'll get into that in a minute. I think that part is really interesting to me because I watched some of your YouTube videos and it was scary what you're saying and it made a lot of sense. Right.
Yeah, I probably shouldn't be saying on LinkedIn, but
you came to DME, right?
I did.
What's your reaction? Yeah, go ahead, Nathan.
We had talked a little bit before that. And you're trying to get a sense of like how big the secondary space is. And
yeah,
that's really hard. So I don't know if you were there on the Saturday morning when we talked about seller finance and Fred put up his slides and showing I think, oh, dang, I'm going to get it wrong, but I think it was just last year, 2023. It was something like 23 billion.
23 billion. Yeah. I saw his slides. I actually featured them, Nate, in a Substack. Yeah. I saw those. And I think that's actually much smaller because I think they're just using what they captured in the MLS.
Yes.
So we know that this is happening outside the MLS.
Yeah.
And so I think,
that's just seller financing.
Right.
That's not even counting
one little component. Exactly.
All the loans that Dave and I bought from banks over the last 10, 15 years.
Yeah. So you got the DME and you realized the secondary market. What was your takeaway from that?
Well, I think the biggest learning, and this is where, again, sometimes we can just be such useful idiots, right? When we assume things. My biggest learning was that the hedge funds that had participated in those single family loan sales that I had worked ever since they started in 2015,
Mhm,
worked on side letter exceptions. I mean, I worked those things all the time. And I saw, okay, you can't foreclose, you can't do this, you can't do that.
mhm,
But what I didn't even think would even make possible is that those could be sold. And that was just like a
mhm.
whoa moment for me. And
Yeah.
I was just like, holy cow. That's because I had always worked with the big guys like Goldman and Morgan and all these people that were playing in that space. I had no
Mhm.
idea they were selling them. Like I had no idea. And then, I think too, when I went back to go look at all the single family loan sales reports, the fact that they've stopped reporting, I felt that was kind of, you can't get a lot of reporting on successful exits. I mean, it feels like, I think they understand how bad their programs are, the GSCs, the agencies, the
Yeah.
administration. And so I think they probably don't even want it to be known how more effective that could actually be, resolved in a private market. And so I think that might be why they don't talk about it very much, but they certainly understand it.
Sure.
And I have a very interesting theory about what's actually going on right now in the treasury markets and what they're trying to affect, which is something very similar to HARP. But I'm sure we'll
Yeah.
get there if we have time.
Yes.
Yeah,
So let's
interesting.
learn about the data right now that you're seeing in the housing market. We've all heard the fact that the housing market's still at a shortage, and I think people use the idea that they're able to sell a house very quickly because there's not a lot available. What is your information telling you?
Days on market for the 80 plus cities I track right now are at 50. Like the housing market is frozen. And anytime they talk about bidding wars again, poke holes, ask questions. What exactly are there? Because they're just trying to create FOMO. Like for instance, a couple of months ago, when we saw those rates drop at the end of last year, a couple of months ago, oh, Dallas, it's hot again. I was like, calm down, everybody. I was just in Dallas. Like it is not hot. Maybe you have one neighborhood where everybody thinks they want there and there's only one house for sale, but I guarantee go back in a couple of months, there's going to be three or four. Sure enough, year over year, price declines in Dallas. I mean, we are
Mm,
seeing so much narrative right now because everybody that is currently in positions of power believe that the wealth effect drives consumption, drives GDP. And so we want everyone to feel much, much more wealthy or wealthier than they are now. And so if you have any concerns about your equity in your house, you are not going to feel wealthy. And so
Mhm.
there is a lot of effort out there keeping this machine running. And a lot of it happened on the back of new homes last year. They could affect those rate buy downs. They could then do, price cuts and all kinds. They'll give you your washing machine, your refrigerator, all that kind of good. They'll pay your HOA fees for a first year.
Yeah.
mhm.
And so the builders really carried the market last year, but they're not in a position that now they have so much inventory over 9 months that
Wow.
they have to get it through the system because they're production oriented. They're not like a single family seller that's like, could wait a couple of months or I'll go rent or do something, it's not the same thing. And so that we saw an historic flip in June. We'd actually seen it in May where new home prices were actually less than
Yes.
existing home prices. When they revised the data, it flipped again, but in June it happened again. And
Mm,
so what we're about to see, and that's only happened two other times in the last 25 years, June of 2006 and June of 2021. Anybody remember what was
Wow.
going on back then?
yep.
So, we are in it
Mm,
and we just broke our pierce the veil of seasonality here. If you're looking at combined sales from an existing and new home sale perspective, meaning on an absolute basis, this is not adjusted for population. On an absolute basis, this June and the last was the lowest sales in the last 25 years of data in a June. And the housing market has
Wow.
a very specific season. and it always peaks in June. This
Yep.
is the first time in those 25 years that sales did not increase from May to June. Now, something else could also be happening though, and that's things in your space, and they're not being captured
Yes.
in those official numbers. But I think directionally, we know that like the markets are frozen pretty much right now. And because buyers are just like, yeah, I know what you tried before, and I'm just not having it. And
Yeah.
I think even if they do get there, they get down at the closing table and they see that insurance bill and they're like, whoa, no. Like we had the highest, Redfin said, we had the highest cancellations they've ever seen last month. And that's
Wow.
existing home sales. You often have
Yep.
cancellations in new homes runs about 12 to 16% historically, but cancellations in existing home, that to see a record there. So I think the consumers got real excited in the spring with the stock market, and they looked
Yep.
at that and said, we must all be getting those that could transact, those in the top 20%, because our consumer is dead on the bottom 80%. And that, but then as things started to wobble at the end of June with the political events that have occurred, and suddenly we're all like, wait, are we being lied to? Are we being, and I don't want to discuss politics, but I
Yep.
think everybody kind of woke up and said, wait, what?
Yeah.
And I think in June, you could see that in mortgage delinquency, we had a 13% increase month over month. We have not,
Wow.
we don't see moves like that. We don't. And 30 plus guys, and I'm screaming like a crazy lady, but you're from this business, so you understand what I'm saying. When I say it to other people, they don't.
Yeah.
A over 19% increase month over month and 30 plus. And they tried to say, Black Knight tried to say it was calendar driven because the month ended on a Sunday. Well, hold on, guys. The month ended on a Sunday in March,
Yeah.
and delinquency went down. Also, I've worked at mortgage servicers. You effective date those
Yeah.
payments.
Yeah.
And if you have habitual late payers, they absolutely know if a holiday's coming up or whatever reason, they've got to get that payment in so it doesn't ding their credit. They know this. We live in a country that is obsessed by
Yep.
credit scores. And so that's kind of like a lot again, but where home sales are in the, down the drain, and delinquency is increasing.
Are
And
you
you're
seeing,
seeing,
go
go
ahead.
ahead, Nate. No, you
I
go.
was just going to ask if you're seeing any of these in like specific markets. Is this, I mean, nationwide, obviously, but specific markets?
Oh, it's always the South. And as a Southerner, it is just, when I was doing the tour of Austin and Nashville and Charlotte, and I was just like, this is like Reconstruction all over again.
Mhm.
The carpetbaggers coming in, just whatever they can get. But it's the South. It's, it's Louisiana, Mississippi, Alabama, but it's increasing in all of these places. And, so two, I think we don't often, like, for instance, you can look at Austin and delinquency is not that bad there.
Mhm.
However, most of the people that bought homes in Austin don't live in Austin.
Mm.
I don't, I mean, there was
Gotcha.
just so much speculation. They
Mhm.
live somewhere else and they bought this sight unseen. And I mean, I cannot, the amount of vacancy out there, guys, is just so shocking.
Yeah.
You're overwhelmed. And so there might not be for sale signs up today, but just on my road alone, where I live, when I first, like 6 months ago, there was one, by the way, it's still for sale.
Mhm.
6 weeks ago, another one showed up. And you could tell it was like a work from home office. I looked it up. And then a week after that, a for sale by owner showed up. And
Mhm.
then two boats, lawnmowers. I mean, the consumer they're at the end of their rope. The top 20% have been doing just fine, but they're getting a little offended. They don't
Yep.
want to go and spend $20 for a martini that tastes like crap and takes an hour to get there. So they're going to
Yeah.
start pulling back for different reasons. Additionally, these political events and what happened in the markets are also going to make them more skittish. And so you're seeing pressure at the top of the K and the bottom of the K too. But what we saw in the University of Michigan Consumer Sentiment Survey is that historically your lower tier and your mid tier don't have the same sentiment. Those have now aligned. And so really all that's left is that top 10%, and they're offended. They're going to start backing away.
So isn't that what the Fed is trying to do though? They're trying to raise interest rates to create hurt, to create some of this delinquency and things. And have they overdone it?
Well, so I think I don't believe they have the power they think they do, just, studying the bond markets. But
Sure.
sure, I think that's what they think is happening.
Yeah.
And I think though you have on the other side of it, Yellen in Treasury, increasing shorter duration T-bills and selling that. And this is what's creating that quantitative easing effect. And that's why you're seeing the 10-year Treasury rate, which is what mortgage follows closely, come down. And
Mhm.
that's also why you're seeing really bad auctions in the 10-year and 30-year, are part of the reason. The other part of the reason are the Japanese, you're getting lower foreign investment, as both, I think, China and Japan are struggling. And so there's a lot going on, but there's a battle right now. There's a battle, it seems, between the Treasury and the Fed. And that is why what's fascinating actually is to watch the 10-year over the past 3 days, it's just battling right with the yen.
Mm.
And so there's a lot going on in the macro picture. And I think that people look at the Fed as they're the ones driving everything. But in reality, it's those external forces that are going to dictate the direction or the decisions that they make, in my opinion.
Yeah.
Interesting.
So I definitely want to get into your seconds conversation because I thought it was a fascinating video. I saw you're talking about the HELOCs and seconds are going out there. What are you seeing right now in the delinquency in the market for mortgages, right? We're seeing in the secondary market for the last 3 to 4 years, anyone who's been in the note space since 2019 has seen performing levels that we've never saw, right? For the last 5 years, I've never had a portfolio perform as well as it is in the last 5 years. It seems like everything you touch right now stays performing. However, we knew for the first 10 years, nothing performed, right? We're waiting for a default and we're starting to see cracks at our level, which is nowhere near the Goldman levels, right? Where are you seeing the data on the 90-day plus delinquencies or 60-day plus delinquencies in the data?
That's such a great question, David. And it shouldn't matter, right? You would think we should be able to just track this easily. Like, why wouldn't the Fed have it? So problem with what happened after the GFC is you had so much of the lending move from the big banks to the big non-banks like Rocket, UW, et cetera, PennyMac. Well, the Fed only tracks commercial banks and their delinquency and their overall. That's sitting where we were 1.71 Q3 2006. Cannot wait for it to update for Q2. It's only released quarterly. Then you have Black Knight. They have about 36 million mortgages based because people use their system, and they claim to have 80%. But after going to your conference, I started asking a lot more questions, and I can see now that's not accurate at all. And especially when I met servicers I had never heard of. And guys, I've been in this space is pretty small. It's like, so to not have heard of those people, like, I know people don't know about them. And so Black Knight had been looking just so stellar. And I'm like, this doesn't even make sense, because you could look at somewhere like Inside Mortgage Finance, look at FCI Lender Services, which is more geared to servicing in your space. They had a 30% delinquency. And I was like, oh, and you could look at someone like Specialized Loan Servicing, where I used to work, they had about a 7%. And so in the Black Knight data, it looks super great until very recently, until that May-June move. But then you could go to the Census Household Pulse Survey, which is a newer, sorry, I almost dropped something, is a newer series. And you saw over 5 million borrowers saying that they weren't current on their mortgage. And it was like, what? I mean, because no one was talking about that.
Yeah.
And now I've heard things about people maybe not reporting, who knows?
There's a lot of seller finance notes out there that they're self-servicing. They're not reporting anyone.
Exactly. And so I think that we have big black holes from Black Knight, big black holes in the data. And I think that everybody's about to get real surprised, because every schedule you saw out there showed auto going up, delinquency, credit delinquency going up. We're here because buy now, pay later doesn't report to credit. It was over 40% delinquency, but mortgage just looked just fine. Not anymore, guys. The trajectory, it's up. Now, default, and I don't have to tell you guys, but maybe the listeners, it's a push and pull. It's never just a straight line down, because people are trying. Yes, they gave up their credit, but nobody wants to lose their home. And they're just trying to do everything they can to stay in that home. they're going to get into a modification program, a repayment program, and they're going to do their best. But all of us here who have managed to file know that it's very sad, but you can stand back and just know that a certain percentage is not going to cure. And so what we've seen is delinquency has gotten a lot more sticky, and you're seeing fallout, more and more fallout. They're not performing in the modifications. They're not performing with the forbearance. I mean, they're not able to cure after the forbearance. And so it's a push and pull, but we now have sticky delinquency. And I believe in the official numbers, nobody's going to have any questions by June of 2025. That is my opinion, that by the time we get there, barring an exogenous event or the UFOs coming to give us high paying jobs, because AI is our biggest headwind. Is it how and if you really think universal basic income is where you want to be, then I don't. It's a really bad idea. So anyway, that's kind of what I'm seeing right now.
And the modifications, and maybe I'm a little biased, but I think we do it better.
100%.
I think we're better at doing modifications than banks are. We're far more flexible. We're more human. We don't have, the box that we have to work in. We can do all kinds of cool things.
We can also make emotional decisions. Like,
exactly.
It doesn't work. We're going to have to foreclose because, listen, you just can't afford this. I don't care DTI. This is going on. That's going on. Listen, we're doing you a favor, and we have that power. Yeah, I totally agree, right? I think banks, the rubber
100%.
stamping is still there.
Guys, I mean, I see it every day. It's like, oh, you need to take this 40-year mod. Well, that's going to reduce your payment by $100 and add that's going to crush your future purchasing power. So I agree. We cannot Henry Ford credit. And we have tried and that is exactly what happened in the robo-signing crisis. They were trying to Henry Ford foreclosure. You can't. It's a legal process. It's messy. It's just messy. And humans are very, very messy, and credit is very messy. And, Edward Chancellor wrote this amazing book, The Price of Time. And it's all about the history of interest rates, which goes back to when we were scribbling on stone walls and caves. I mean, so I think both of you would actually really enjoy that book. It's such a great
after hours.
Yeah.
So I'd love for us to dive into this, and I did talk to Nathan about this. What do you think is going to cause, if anything, our next 2007, 2008, for those who are creating assets right now? There's a lot of people that are creating notes. They're doing wrap notes, which they're wrapping around delinquent debt that's at 3%. I talked to someone just a couple days ago where they literally bought a property that the unpaid balance is 300, the value of the property is 300, and they wrapped it with a $305,000 wrap note, simply because the underlying debt's at 3% and they're going to now charge 10, so they make it a 7% spread. For those who are doing that, what do you say and what do you feel?
Yeah, guys, I understand that every schedule out there is talking about how much equity everybody has. Here's the problem. Well, here's one big one. 1.8 million people had to take a workout from those forbearances and something called the payment deferral, which was actually taking those 18 months of forborne payments and putting it on the back of the loan to be paid off when that loan is paid off. They did not record those. These are silent seconds. They are silent seconds, and you may not have any idea they exist if you're only looking at public record. If they did the partial claim, those were likely recorded. That's because it was that's the FHA product. But so I think the equity picture out there is not what they're reporting, because I also have worked at companies that report that stuff to the bank, to the Fed. Let me tell you, it's a spreadsheet, guys. And if you don't understand, it's nothing fancy. They're not, and so if they're using Experian, for instance, to look at, some of those servicers do report both balances. Some of them don't. Because of their system limitations. So I think the equity picture is not as great as everybody thinks. And then also, guys, the market has been frozen for almost 2 years. Okay. There has been no price discovery. There's been zero price discovery. We are building inventory, over 30% year-over-year increases in inventory, and way back in many locations at 2019 levels, but and I can tell you why. I don't even think that matters. So this is happening. The inventory is there. It's sitting. Those that are in distress, those that need to move, those that are also scared, they will start moving that product at the same time the builders are. And we will have price discovery. And it can happen, as we often say, gradually and then suddenly. And so they went up suddenly. They went up over in an 18-month period, right? They can also come down very quickly. Now, that's not my base case. I think the worst of it is going to be 2025.
So before we get there, though,
Yeah,
one
go
last
ahead.
question: how can you find out about those silent seconds? What is a
I've had a
good
couple
way
of
to?
people
Yeah,
asking about those.
The only way is to talk to hopefully the borrower knows, but I can tell you, I've seen so many Reddit forums. I've seen so many social media comments on Facebook. They're like, I didn't realize I was underwater. I had no idea.
because they're not recorded because a forbearance agreement. It's not a second; it's a forbearance agreement that's pushed to the end of the term. Modification, really.
Well, so you had the forbearance. The workout was a payment deferral. And when they first came out, they talked about recording them. And I was like, absolutely. Of course we're going to record them. Are you crazy? Like we record the mods. We always
Yep.
record the mods, right?
Yeah.
Quickly that went away. So you don't know. And most consumers don't even know. They don't know. They don't know. I've seen so many like guys, they were so under stress, a lot of them. Like you just signed the dotted line. Like, wait, you mean I don't have to pay this? Awesome. I mean, you
Right.
guys know this more than I.
Yeah.
You live this, you breathe it.
Yeah.
And so they don't know. And so they might be working with your seller financing guys or, those
Yep.
doing this too. And they might say, well, yeah, this is, you know, so then you need to tell them the way you're going to find it is tell them, go get a payoff quote, right? You need that payoff quote. If
Okay.
you get that payoff quote, it's going to be on there if they're a
Correct.
good servicer. So that's the way, but it's not going to be on title. And,
So-
and yeah, go ahead.
Cindy asked a question. Can you define bezel?
Yeah, it's my favorite word of this cycle. So this is a word that just means the inherent sort of fraud in the system. And so the Philly Fed did a great paper that said when mortgage investing in mortgage did not stop after the GFC. And in fact, it accelerated. And they said that basically 30% of all mortgage loans that are used for investment were fraud. Like, and that could be non-owner occupancy fraud. That could be the fraud that you're hearing a lot about with straw buyers, or just make up whole portfolios. But essentially, you don't know. So, for instance, let's take the situation where I think it was Chase's nickel or silver. I can't remember. They thought they had millions of dollars worth of silver in a safe for 2 years. They thought it was there. It wasn't until they went and looked and saw it was sand that they realized they had that loss. And so the entire time they were acting like they didn't have that loss. This is the American consumer right now, because not only that, we're seeing Fannie Mae came out with an appraisal letter that said they reviewed over 7 million comps and saw that in 55% of the cases, seller concessions were not accurately placed on the appraisal and didn't reduce the price, leading to inflated appraisals. So, and then you're seeing things down in Texas like Central Appraisal District fraud, where they're not actually doing a good comparable because they basically want a higher market value to get higher property taxes.
Sure.
And so there are just so many different things happening all over the system that are making those prices seem inflated, that the minute you go to turn around and sell that home, that's just a whole different scenario. And so 305,000, I mean, I wouldn't touch that with a 10,000
No.
foot pole.
Yeah.
No way.
Yeah.
So tell me about how seconds are going to become one of the biggest factors that play into the crisis moving forward. You were saying on one of your shows that you think that seconds are going to be a disaster because of the equity being stolen out of people who have no money.
Well, if they do it. Yeah. Yeah. I mean, it's extraction, it's debt slavery. And, essentially you were just and what we don't realize in this country is we're actually crushing purchasing power by doing that. It's just the same thing that happened last time. And this is what kills me about it, is that we've already done that to some degree. What I just kind of told you about, people don't really understand. And so to me, this is just signing your life away, but
Mhm.
the Freddie program got approved but very limited. And so I don't think it's going to have a huge impact just because the people that probably would need it or would be in that horrible position will probably not qualify and they will probably can't even afford the closing fees. And
Wow.
so
Thank
I think
God.
that, yeah, well, right. And I don't ever like it when government tells us what to do, but dear God, that this is just because what'll happen is those loans, the reason why Fannie and Freddie want to do it is because the banks are being very cautious. And I mentioned how JP Morgan already has a 6% delinquency on his home equities. The banks are being cautious. The non-banks need the juice because they don't have deposits and they don't have liquidity. And so they are absolutely dying on the vine. But what happens is just what happens like with FHA. You keep pushing people into products they cannot afford.
Mhm.
And the thing they do right now, because they have a ton of equity, right? I got 100,000 equity. Let me go grab
Mhm.
a hold of it because I need to make medical payments. And I'm going to go ahead and get that phantom equity, which in a year or two is going to be down because, I agree. I think housing price right now is flat and that equity is not going to build up. And then now they have
That's right.
no money and more debt.
Yeah. And,
And
more debt and less freedom, in my opinion.
Yeah.
and it throws right back to 2006 where it's like, oh no, zero down payment loan, no problem, because the
Right.
house price is going to keep going up. Equity is going to
Right.
be built in as the house price
Yeah.
increases.
Date the
Yeah.
rate,
Really?
date the rate.
Yeah. Yeah.
Really?
Your hope and
It's
appreciation.
mind boggling. It's actually mind boggling. Instead of instead of saying, well, I can always refi, they said
Mhm.
date the rate. Well, they meant exactly the same thing. Like what? I mean, we have just, it is actually a study in humanity that we have, it hasn't even been that long
No.
since all of this happened. But it's just kind of a study in how the generations turn, how you lose lessons. And I mean, here we are repeating all the same behavior. And seller financing was big in the 80s, right?
Yes.
Back when
Yep.
they had, right before
Yep.
long-term capital management crisis and S&L crisis. And so, I mean, I think that's yeah, it's coming back.
Fascinating.
It's coming back.
Oh,
One of the reasons Texas didn't get hit as bad in the GFC was because of legislation that came out of the S&L crisis around wraparound seller financing. But not now they're the biggest in seller financing, right? They were number
wow.
one on that guy's presentation. I saw
Yeah.
a DM it. Yep.
Yeah.
And my kids are wearing my high school jacket and my wife's high school jackets. It's the same thing.
Yeah.
It was in fashion back then. It's coming back in fashion now, but
Yeah.
it's not good news. It's
No.
No,
uh, it's not something to, yeah, be
Yeah.
it's a
happy
bit
about.
wild.
So
Fascinating.
let's focus on the fact of us as note creators and note buyers. What advice would you give these note creators who are doing it now to do it correctly if you were to give them advice? And for note buyers, what would you tell them the best suggestion right now to do?
Follow you guys. I mean, because no, I'm serious because you take it seriously. You're not in it to get famous. You're not trying to be one of these gurus on, you're legitimately just trying to educate people for success and a space where you have been successful because I don't live your space every day. I mean, you guys did a great job at the conference educating people, providing network opportunities. So that is what I would say. But then,
Hmm.
have a good attorney. I would also say, but
Yeah.
and that's just hard these days too, because I don't know. It just feels like you can't trust people to follow through anymore. But you need a good attorney, and you need to understand title, and you also need to understand that legal standing. Whether you think you are a armchair lawyer and can read a statute, that does not matter in the courts. Often, legal standing has really been dictated at a national level through that Consumer Finance Protection Bureau National Servicing Standards, and that is possession of the note. And if you don't have it, you are going to be in a world of hurt. And so that is what I would say is that default doesn't work how you think it's supposed to, and it doesn't work how it says it in the statutes. And it is and if you are kind of relying on your understanding of the law by reading it off of Google, you're going to be in trouble every single time. And you need experts like you guys to really tell you the tricks of the trade.
And I'm gonna tell you, we're not the only ones, right? We've been through a
No.
lot, but
Mhm.
there's certain things we've never been through. And we have to be honest with ourselves and say, listen, that's why we connect with other people, because every situation is different. It just, you gotta be networked in. We always talk about networking because the fact that there's so many possibilities out there that just sharing your experience is key for everything, and being part of groups and part of communications and being part of conferences where you get together with people regularly and just hear it from both sides, buying as well as creating, of fears, concerns, worries, and understand from this side, because we're seeing a lot of note creators who create notes and the note buyers buying at par to go get a 12% loan, and with
Yeah.
no care in the world of it defaulting because that hasn't. And note creators continue to create notes on leverage because they, hey, listen, it's been working for 4 or 5 years now. I'm going to keep doing it. It's making me money.
I know
David,
creators that are doing one-page notes and like, oh my goodness, really?
I've,
Like,
I've seen
no.
them. People have sent them to me. I'm just like, you are out of your minds.
Yeah.
But David, you said what I should have said. But the leverage, guys, the leverage, you do not own that thing with all that leverage. Like, and so I think, of course, you're going to use it smart, but that is really the key. Don't over leverage yourself.
Yeah. Yeah. I think people only plan one track. Like, it's performing for 12 months. It's going to continue to perform, or that borrower has the ability to repay. Doesn't mean they're going to pay.
That's
Right.
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 Life
Things
happens.
happen. Yes. And it
Life
could be no
happens.
blame to the borrower. It could
Correct.
be no blame at all, but you
Right.
have to make sure you're smart with buying that note, that if things happen, you're still covered, and that the investment to value, or LTV, is decently low so that when things do happen, you have some equity in that deal.
I'm sure all those people at Intel over 10,000 didn't think they were going to be losing their jobs
Right.
or Stellantis or
Yeah.
I mean you're just the layoffs are coming fast and furious now.
Yeah.
Macro Edge, it does a great layoff tracker. I encourage people to look at that, but they're coming every single day, closures, bankruptcies. We have entered the default cycle whether mainstream media wants to admit it or not.
Oh boy.
And by the time they report it, it's too late.
Yeah.
It's way too late.
Yeah.
Mhm.
And
Way
we
too
we
late.
we do a private call on a weekly and bi-weekly basis with very seasoned people. And if you are listening, you're curious, let us know. We'll get you more into it. But we're trying to take the temperature of everybody. That's the point of networking, is
Yeah.
get the idea of what's happening out there outside your little bubble.
That's
Because you're
right.
going to learn different rules, laws, as well as what the population of notes are right now. Because
Mhm.
your notes are doing one thing doesn't mean the whole market is. And there's rules changing constantly. Texas passed a law that doesn't allow second liens to be, servicing fees to be attached to the borrower. It's over 10%. Things like this we didn't know a year ago, but by networking with the right people is crucial, right?
Yeah.
Um, I'm a big believer. Don't over leverage. Don't kill yourself. Make sure you have the rainy day grandma fund. I'm a huge belief in that. And other people say, you know what? Take the equity of your house and go buy properties. Don't use your credit card to buy investments. Get your house in order first and then start doing it. Same thing with borrowers, right? Make sure you have some equity in the house because you never know when you're going to need it. It's scary out there.
It really is.
I'm amazed by the housing things because everything out there told us things are selling within a week, within 24
Mhm.
hours. But just like probably going to casino, hey, I won money. You didn't learn about all the other losses that we had.
Yeah.
Right.
Yeah. Very interesting, Melody. It's been great having you on here. Any other questions, Dave, before we wrap up? Or are we
You
good?
go with your final question, man.
So, I mean, you've you've seen a lot. You've been through a lot. And so we're trying to always kind of predict the future here. What do you see coming? Like it sure sounds like we're looking at another wave of defaults. Is that what you see, or what do you got?
Yeah, we are, but I also think we shouldn't be looking at all the old places. Like they're not going to be on the bank's balance sheets.
Yeah.
We'll see it at the non-banks, but I'm more curious about your world, and so I think that they're happening, um, and so just and where it started. So the servicers, I talk to them. I still have clients. where they first started seeing it back in October is they were get bankruptcies. And because we were seeing bankruptcies increase, not yet foreclosures because all the programs, but they would run title for bankruptcy and they'd be like, holy cow, they'd have to go back to the investor and say, hey, you're in third position. You're in fourth position. And the investor's like, what? Like what? And so I think that where people are expecting foreclosures, that's not going to happen because of all the government intervention, or if it happens, it's going to happen so slowly. But there's a lot of properties out there that I've seen that are already vacant that the counties are soon going to be waking up and saying, wait, what's happening over here? They haven't mowed their grass, and it's more and more and more because investors walk away. So yes, we've entered the default cycle. There will be push and pull, and it won't show up, as it'll look a lot better than it is. I think that what we have just seen sales crater. We're hearing that the builders also are seeing even more reduced traffic this month. So that'll be interesting.
Oh.
We might get a little bit higher in existing from the rate issue, our rates going down a little bit. But I think we will see, by this time, year over year declines from this year. Case Shiller takes forever. So it'll take some time, but we'll see around a 5% reduction in prices this year, in my opinion, by the end of it. And then then essentially I think 2025 is where you're going to see double digit drops. Right now I think about a 12%, but if we have any kind of credit event, if we have massive job loss, all of that just goes on steroids and it just happens faster. And people shouldn't be surprised if it happens as fast as it did in the run up to home prices in the first place. And so I think that, we've got a 5-year correction in front of us, if not longer. But we don't know how is the government going to respond.
Yeah.
And that is truly, I think looking at that will help us understand. But I think that the horse is out of the barn because of the private note space and because of so much financing that happened outside the mortgage banks through personal loans and things like that.
Yeah, I think the zombie foreclosures are probably gonna be coming back, but I agree
Absolutely.
with you, not on the bank balance sheets. It's gonna be investors who just went belly up, who are saying, crap, I just bought created a bunch of notes that I could not afford. What do I do now? I think the wrap notes are gonna be hit too, because these people are wrapping with no equity. And then the
And that's
borrower
happening.
saying, I'm
Yeah.
done.
I think it's Sonoma out in California.
Yep.
There was one big guy that came out. You guys saw that story where he basically bought the whole town and now it's all in foreclosure. I think you're going to, and then like you mentioned immigration, Nathan. I went down to Colony Ridge. They had a 47% foreclosure rate down there. I mean, these 30,000 homes, it was insanity because it was more seller financing versus a bank, and they could get away with that foreclosure rate. So anyway, the story is out there. It's just not being told in mainstream media.
It's
So
it's a
where can we follow
bittersweet.
you,
Yeah.
Melody?
Yeah, how can we follow you? Those who are curious, I'll put the link in. You're gonna see all the links for Melody, her email, as well as her social media, whole bio. If you need that, please go back to the chat box or send me an email. There's a whole list of information. Melody has been on YouTube, and we're talking beforehand about Twitter and stuff like that. The idea is just to listen, right? You may not have to ask the questions, just follow and listen. And some things you may not understand, right? There's things that I don't understand, Nathan understand, but just start becoming knowledgeable, right?
Right.
And just listen to stuff and just start picking up the here and there things, because being in the know will be the actual place where you're gonna be, right? We have someone comment on LinkedIn saying that your facts, they follow you on YouTube. That's awesome, right? Just understanding what the market looks like is
Right.
key. And
Right.
what's coming 6 months down the line,
Right.
possibility, and what we're
Right.
seeing or what we're not hearing at all, which is
Right.
even more scary.
Because your leading industry analysts are not going to tell you. Mark Zandi, for instance, 6 days ago was talking about a soft landing, gets unemployment, calling for rate cuts. This is an industry analyst in the housing. And he led my executives right off a cliff as well back during the GFC. They aren't looking forward, they're looking backward. And so things may look okay on the surface right now. If you're not paying attention to what's happening underneath the surface, you will always be surprised, just like you were during the GFC, if you were old enough.
Yeah, awesome. Well, Mel, we're gonna disconnect from the live feed. Hold on for after hours. And thank you very much for joining us on this Friday afternoon. Take care, everybody.
Thank you
We'll
so
see you guys
much.
soon.
Thank you.